So here's an important question. Are debit cards more dangerous than credit cards?
Brian, I'm excited to talk about this because I was surprised, right? We live in our own little worlds where we kind of get blinded by our own biases, and perhaps we don't recognize that other people out there have different thoughts, different preferences, different ideas. And when you start asking people this question, you can really see how unique and different folks are. So one of the things that we want to address is we've kind of done some investigating around this is, which one's better? Which one should I use? Which one's more dangerous? Which one's more helpful? And we're going to hopefully dive into a little bit of that today.
Well, let's give them a little context first, because Reby had to dig hard on this to figure out what was the actual debit card use versus credit card use. And the best stat we could find was actually from NerdWallet. And we found that 44% actually said that they use their debit card primarily for everyday purchases. So these are people that are kind of preferring to use debit cards over credit cards.
Now, and perhaps this isn't exact math, right? Because I don't know if the question was worded, do you use a debit card or a credit card? But what's interesting is if you think about the way that we pay for goods and services, it probably either has to be a debit card or a credit card or cash, and then I guess maybe even like digital pay is now an idea. But it sounds to me, if 44% relative to the 4 different ways you can pay, a big swath of folks are using debit cards for the majority of their purchases.
I would love both, because a lot of people, they looked very similar. I mean, if you hold your debit card next to your credit card, really the only difference you're going to see is that word debit that's right above either the Visa or MasterCard logo. Walk people through, what are the difference? When we say debit card, what do we mean? When we say credit card, what is that?
Yeah, so let's talk about what they each are. And let's talk about, even before we talk about some of the similarities, let's talk about did you just see my screen go out? So sorry about that. Okay, here it is. There we go. Sorry, let's talk about the similarities. It just completely disappeared on me. I totally spaced. Here are the similarities between debit cards and credit cards. They're both more convenient than using cash, right? So when you think about being able to be at a store, having a transaction, and you swipe, they're a lot more convenient than having to pull out the wallet, count out the cash, give it to the cashier, and get back change.
Yeah, and the reason, let's first, I think that I want to give some baseline understanding of what these things are. A debit card is actually connected to your checking account.
Sure.
So it's often when you set up a checking account, they're going to be like, hey, do you want an ATM card or a debit card? Or a lot of times they don't even ask you, do you want an ATM card? They're just going to assign you a debit card, which acts not only as your ATM card, but it allows you, because it's either got the Visa, the MasterCard logo on it, so you can use it in the stores. Credit cards are different in the fact that you're using the bank's money. You're not actually using your personal money. The bank is going to lend you their money, and then if you pay it back in a very short period of time, 25 days or so, they will not charge you any interest or carry cost on that. That's the big difference that they are. And Bo is right. He's kind of shared. The similarities is that these things are very convenient. They're even probably more convenient than cash, because all you got to do is you either tap or swipe. You don't have to get out change. You don't have to deal with all that stuff. It's a really easy thing to use.
And another similarity is, and it's hard to discern if this is actually a pro or actually a con. We'll talk a little bit about that later on. But it removes the tactile, and we use the word benefit, of feeling cash disappear. So when you swipe, you don't actually feel your wallet getting lighter. When you swipe your card, you don't necessarily feel your account going down, whether you're swiping a debit card or a credit card. So it is a little bit different from the user experience when you go to make a transaction.
And I do like, in this new modern world where there's a lot of crooks trying to get use of your resources, sometimes even more than you are, I do like that both debit cards as well as credit cards will allow you, they have now chip technology in them for security. They also, that tap to pay technology really adds a layer there that's not only convenient, but it does protect you. And that's kind of nice. Both of these, whether you're choosing debit or credit, that you can benefit from that.
So they're obviously similar. They are cousins, right? But there are some unique and distinct differences that make sense to know and make sense to decide if I'm going to be a user of one or a user of the other. How should I decide which ones? Let's talk a little bit about those differences. Here's the first one, and it's sort of this behavioral idea where Your debit card, as you already alluded to, Brian, is tied to your bank account. When you swipe it, money comes out of your bank account. Your credit card is not tied specifically to your bank account. So there's another layer there that you have to be aware of.
Well, and this gets back to, you mentioned on the tactile difference between cash, debit, credit. I find if I have actual cash in my pocket, I'm much more likely to spend on little stuff. I'm talking about going by the coffee shop. The kids are with me and they hold up the chocolate bar at I'm more likely to say, sure, why not? Because we're paying for cash. Bigger transactions seem much easier to swipe the plastic. So when you get into the fact of what's tied to your bank account, what's tied to the bank's, let me borrow that temporarily. I think there's even a difference between the way those two behave. And if you're just in the budgeting stage, maybe the bank account through the debit card is very powerful to have that affirmation. Another
thing that's unique about them is when you have fraud. And we just know that in the cyber world in which we live now, fraud is not an if it's going to happen, it's a when it's going to happen. And so there are different levels of exposure. With your debit account, your actual account is exposed. That means that if someone does have fraudulent transactions, they are taking your money. When you use a credit card, you have a little bit of limited exposure because when there are fraudulent transactions that come through, it's not actually your money that's being taken, it's the bank's money. So there is a level of separation there.
Yeah, I think it's important. I think banks are trying hard to really do a good job of messaging this and even overcoming this difference. But it is interesting. I think if you're the biggest places where scam locations are occurring is like at pay at the pump. If you think about it, it's not uncommon for crooks to put something in front of those where you stick your credit card in.
And immediately swipes
the restaurants, you could have a shady employee that's doing something inappropriate. We remember back when we lived in Georgia, there was a Mexican restaurant that there was an entire sting that ended up having to uncover why so many people were having their credit card information stolen at one restaurant in town. It's a very popular restaurant too. And then of course, online shopping. I mean, I can tell you, I personally have had a credit card compromised by these sites that offer you, I was buying paper for the business, and the deal was too good to be true. And the reason they were giving me too good of a deal on the paper that I was buying is because it was basically a site set up to sell products below market, but they were then going around and gathering and farming all that information to go then use your credit card inappropriately. You have to be careful and think about those scam locations when you're trying to figure out if it's debit or credit.
Another big difference, and this is probably the one that gets the most press. This is the one that folks often talk about the most, are the rewards. With debit cards, often there aren't any rewards, or maybe there are very few. We are starting to see some players enter the marketplace where there are rewards, but when it comes to credit card usage, and one of the biggest selling points, one of the largest items that they spend advertising dollars on is to tell you of all the different possibilities you get with a credit card, whether it be cashback or travel rewards or store discounts. There are a lot of benefits that can come from using a credit card.
Well, I mean, cashback. You mentioned that one. The travel. If you're there's people. There's an entire category of people that make a living telling you how to maximize the rewards when you travel and so forth. I like the extended warranties. I've actually used that benefit on a few electronics. I had a Roku player that went out a number of years ago, and I was able to get a brand new one upgraded because I had the extended warranty for my credit card. Purchase protection. If you by chance the price got cheaper, some of these higher end credit cards will help you out on that. I've even seen where they will protect you if you drop or break your phones and so forth. The insurance when you travel, think about like rental cars, lost luggage. A lot of that stuff is provided on some of the higher end credit cards without you paying anything for it.
And some even provide what I would say luxury benefits. You may get access through having a credit card to perhaps other things you might not have access to by being a card holder or by being a member.
Well, you remember we had Clark Howard, who's a big hero of mine on the show, and I was shocked when I found out that Clark, who's one of the most efficient users of resources out there, had an Amex Platinum. And I was like, Clark,
it's got a big annual
costs
fee
like
on it.
$700 a year. But then he made the case for, but if you take in the automatic upgrades, when they upgrade your tickets to business class when you fly international, the free breakfast when you stay at all these resorts and stuff, it really added up all. And I'll go ahead and tell you, I went and signed up for the Amex Platinum. My wife had been asking for it for years based upon Clark telling me the benefits. And we've already, because they track how much benefits, I have twofold paid for the annual fee through all the free stuff they've given me, whether it's Uber money, whether it's paying for my Hulu. There's all kind of crazy benefits these cards give you.
So it's easy to see because of those types of things how people choose to use credit cards. Now we're going to talk in a moment. Is that necessarily a good thing or a bad thing? But back to the differences, looking at the differences between debit cards and credit cards. Another one is availability. With a debit card, pretty much all you have to do these days is open up a checking account or a savings account and you can be given a debit card to use. With a credit card, you have to get approval. The actual company has to approve your ability to be a creditor to them. They want to make sure that if we extend this personal line of credit, we feel that they can pay us back. So a lot of folks, especially young folks, might have a hard time getting the credit card that they want because there is an approval process necessary to get
Well,
in there.
and that's a great segue into just credit in general. If you think about building credit, your credit score is not just, can I go get this loan? Can I not get this loan? It's also now impacts utilities. You know, they'll go pull your credit score and they want to, and they're going to determine whether they're going to take a big deposit from you. If you think about your property and casualty insurance, you might be surprised to find out that your auto insurance is heavily influenced by your credit score because they have done research and it shows a lot of these insurance companies have realized that there's a correlation with people with great credit scores are actually really good people to give insurance to because there's some type of understanding of risk and not filing claims. So it's a really good benefit for insurance companies. So credit score does have an impact not only on your ability to access resources and cash like loans, but also what you pay for insurance, and then the ability to have utilities without a deposit.
So it's really interesting, Brian. We can kind of see the similarities and the differences, but there are a lot of voices out there that run blogs and have businesses built around, hey, credit cards should be the only thing that you use, and here's why. And they'll list out a number of reasons. And then there are other voices out there that say you should never use a credit card. You should not even have that in your financial tool belt. So if that's the case, what do we do? And then what's our take? What is the money guy take on which one is better and how you should use it?
Well, and let's talk about this from, I think the money guy's take is, I think, and this is when I designed the financial order of operations, we pretty much inherently count on you having enough discipline that I'm going to treat you like an adult, that I don't actually think that there is an inherent difference of whether either one is good or bad. I think, like, if you're budgeting, if you're brand new to the financial concept, debit cards can be really powerful in the fact that if you don't have it, you can't spend it. And while you're trying to get your training wheels and your foundation financially underneath you, that is a really powerful thing. However, if you're a full-on financial mutant and you pay off your credit card every month, credit card rewards because I always tell you, as a financial mutant, I want my money to go 3 to 5% more than anybody else. I want a better deal. I want to get better benefits than the average person because I really spend a lot of time maximizing and thinking about financial decisions. Well, it's really easy if I know my credit card gives me an automatic 2% rebate or essentially through cash, refunds throughout the year. That I've already gotten 2 of my 5% that I'm counting on automatically. That's why I think they're not inherently good or bad. They're both financial tools.
So if I'm going to recap kind of what you just said, is you said, first of all, they're just tools, which means neither one of these things will be your ticket to wealth. They're not going to be, no one is going to reward themselves into wealth. That's not the way that they work. But they're tools that you can use, assuming you have the behavior right. And I love that you said this. Rule number 1, if you're going to be a credit card user, is never, ever, ever carry a credit card balance. If you're someone who finds that it's really difficult for you to run up that bill and pay it off in full every single month, then maybe you fall into the camp of someone who just should not use it. You should probably not be a credit card user. And even if you're walking away from the benefits, it's very easily for those benefits to just start going away once you're paying interest charges for carrying a balance month over month.
Well, we've said it before, is that credit card use is okay. credit card debt is no-go land. And that leads to number 3, you have to know yourself and act accordingly. I could not help myself. We have this perfect sample here, and maybe this warrants us having a survey within, because this is part of the live stream here. But I want to know how many people, because I consider definitely our financial advisors, we eat our own cooking, meaning we actually practice what we preach here. I want to know, financial advisors, do y'all have credit cards or do you use debit cards? And I even gave a lot of latitude. I said, tell me, if you use both, that's okay. I just want to know, what are you using each for? And I was shocked. The entire financial planning staff only uses credit cards. Debit cards are only used to pull money out of like an ATM.
Sure.
And so then we went beyond just the financial planning staff, and we went to support, the kind of the administrators as well as content team. And the majority of non-financial planners actually used a mix of both, but debit cards was the primary spender. Did I get that right?
Yeah, no, I think that's right. And what's great is I think we put a poll out there. Reby, do you have the results of that poll? Did you see the numbers that came in that? And basically the question that was laid out was, are you primarily a credit card user? Are you primarily a debit card user? And then I think there were some who say I use both, right? And when we looked at the poll, Reby, do you have the numbers right in front of you?
I'm looking for the numbers. They kind of got pushed up the chat. Let's see. Oh, yeah. But okay, primarily credit card was 73%.
So wow. Chat. So it's not surprising. So this is kind of the thing that we discerned. If you are in and around the financial world, which I would argue all of our financial planning team, obviously in and around the financial world. And if you're someone out there listening to a financial podcast, you're sort of in and around the financial world, it doesn't surprise me that the vast majority use credit cards because they do have the discipline and understand the benefits can be garnered from doing that.
Well, I think, and look, debit cards are great, as I said earlier, for the behavioral aspect of making sure that you're building discipline, you don't spend more than you have, and as you're trying to put expenses into different buckets. I think that is very affirming that you have a backdrop to how much you could spend.
Yep.
Now, Daniel made a great point. He was like, because I brought up, I was like, well, debit cards are great for that foundational side. And he's like, yeah, but so is my credit card. And I get the rewards. I get to maximize the rewards. But when I combine my credit card use with you need a budget, he uses YNAB as a resource. He feels like he turbocharges his credit card where it has the same benefit. Now, look, it doesn't protect you from... You still have a behavioral risk if you're not disciplined enough, because when you swipe the credit card, since it's the bank's money, the transaction's going to go through, whereas the debit card's going to be that uncomfortable transaction and be like, they're going to judge you hard and be like, this poor person can't actually afford this transaction. Yep. But it is something that I think there is a way to kind of get the best of credit cards, but whatever the case be is, you have to have discipline to know where your money's going. And I love that our financial advisors, I think the reason that they do lean hard on the credit cards is because they are paying them off monthly. Yep. They already have their wealth building journey, meaning the automatic investing set on autopilot where that money's coming out. The spending is under control so that you can figure out for your own personal life, what's the best way to maximize every dollar that comes into my control?
Now, what I want you to hear is maybe you're someone who's using a debit card. This doesn't mean that you flip over to credit card all the way, or maybe you're someone who's using a credit card that flips over. You have to figure out what works for you. And one of the things that we love doing here is help you guys figure out what works for you. How can we answer questions that you care about? How can we speak to the things that are true to you? So what we're going to do is right now, we have our team out on the wings and we want to load you up. We want to make sure that we answer the questions that you are curious about. So if you want to get our take on something, want to have information from us, make sure you get that in the chat. With that, Producer Reby, I'm going to throw it over to you.
Great. Yes, I have a first question for you from Fu Manchu. He says, what do the money guys use as far as credit cards? Okay. So when he's thinking about knowing himself and what he's looking for in a good credit card, do you have any insights?
Yeah, so I'm going to I'll tell my stable because mine's pretty quick and easy. I'll give you my exact stable. And full disclosure, we don't have affiliates with any of these. We don't get anything from recommending these. I'm just telling you what we use in my household. For most of my everyday purchases that don't fall into a different category, I use the Fidelity Rewards Visa card because I get 2% back on everything, rewards automatically deposited into my account. I also, because we do a lot of shopping on Amazon, and every now and then we like to go to Whole Foods. We also have the Amazon card because we get 5% back on that, which is a great specific credit card for those types of purchases. We use the Target Red Card because my wife also likes to do a lot of shopping at Target. And then we have the Costco City Rewards Visa, which gives us the categorical spending, saving on gas, saving on travel, saving on Costco, and then there's a spillover for everything else. Those are I don't know if that was 4 or 5. Those are the ones that we use that pretty much round out all of our consumption.
Well, and I think it's important, like you said, Target, you said the Amazon Prime card. Those are valuable just because it's 5% right off the top.
Right off the top.
And that, by the way, that applies to Whole Foods too. That's the one I kind of look at and go, man, why don't I have that card?
You don't have an Amazon card?
No, I don't have the
wow.
Amazon. Just because I didn't want to add another layer of complexity because, I mean, my stable is, of course, the Fidelity Visa is 2% on everything. That's the one, if you don't know a category that's maximized, the default should be just that Fidelity Visa because it's just 2% on everything. Now, the categories that I can get a little bit extra, I also have a Costco Visa card, and that's with Citi. And what I think is interesting on that one is that it's 3% on restaurants, 4% on gas. So you can imagine. I tell my wife because I have an electric car, but my wife has the normal car, and I try to as much as I can once a week to go get her gas at Costco because it's like 30 cents a gallon cheaper here. But I've told her, I was like, if you're not going to do that, if I'm not taking, because she won't go wait in I used to say the Jimmy Carter gas line, but now you can say it. We've had periods in the last 2 years where it's been like that, even now with our crazy inflation and supply chain issues. But Costco always has huge lines. She won't do that. So it's a matter of, I tell her to use the Costco card, at least get the 4%. And then I have, of course, the Amex Platinum that Clark Howard told me he had. And as soon as, I saw he did it, I was like, well, if it's good enough for Clark, it's good enough for me. And it's been really powerful for traveling. And I'm trying to think if there's anything else. Those are the big three. My wife does have okay.
Here we go.
What's funny, I think I know where you're going. I was about to talk about that.
So here's the thing. There was a moment in time where it was some encouragement on her side of the family. They were like, you got to make sure more of the credit and stuff like that is in your name. So my wife was like, I want a credit card that only
is in my name.
Sure. And then we'll get you a side card, like because some of my cards, and I think that's a good thing. I just wish the reason you see apprehension or delay is because the card we chose would have so benefited if I was the primary because I just travel more for business and stuff. So we have a Southwest card because if you live in Nashville, that is the airline where all seats are first class and they fly direct out of Nashville to a lot of places. I'm from Atlanta. Delta spoils you, but here in Nashville, you kind of have to have Southwest. And so she likes the Southwest card because she's now on their A+ whatever. Sure. But it's great when I fly with her because I'm the companion and I get to, to do all that.
But you don't get the benefit from it.
But when you and I go travel for business and we should be totally getting the status benefit, but it's all, and I support it. I just wish we'd have done it maybe on the Fidelity Visa or maybe even the Amex Platinum because that Southwest, I just travel a lot more than my wife does and we don't get to maximize that benefit.
Here's one thing you noticed that we did not say, and I think this is important to mention. Because my wife asked me this. Sometimes she'll be at a store, she'll be checking out, she'll say, hey, I shop at this store a good bit. Should we do the credit card here? Because I'll get a big discount right now. And I'm like, okay, while that may be true, that's just one more account. And it's specialized to a store. So as much as we can, we try to avoid the specific store credit cards. The one that are specific to that retailer. I'm assuming there's probably a place where that could be justified, but for us, to keep things simple, we choose not to dive into those.
Except for, like you said, Target.
Well, Target, that's a grocery store. That's not shopping.
But to be fair, you've chosen like one or two.
That's right.
Let me ask one, and I don't know if we have the ability to edit. My wife is still mad at me that I will not let her do or that's not the right. We have agreed.
Oh my goodness, I know where you're going, and I might have pie in my face. First, I know where you're going.
Nordstrom does this incredible pre-sale where they let people in for like a week before everybody else.
Okay.
And me and my wife have had discussions because we've had we've had a mistake financially back when we were buying our very first house back in the 90s, where a store credit card cost us like 25 basis points on the mortgage because somebody had opened a store credit card, didn't tell me about it. Our credit had a ding on it because all that 10 or 15% had blown up a lot of stuff financially. So we now have a rule: we don't do store credit cards. Nordstrom has been a bone of contention in my house. And then imagine my surprise when I found out somebody in my content circle here has a Nordstrom credit card.
All right. Full disclosure, I was wrong.
I was gonna say
I was
it's
wrong.
not me.
We do have the Nordstrom card, but here's what I do. So I pay my cards every single month. I log in, pay them on the first day of the month or the last day of the month every single month. And Nordstrom, there's not often a balance. I check it every time, but oftentimes there's not a balance there. So I don't think of that as being one of the stable, and I don't carry it around in my wallet. But technically, yes, we do have the Nordstrom card. Thank you for telling me.
I'm here. I'm here to keep you straight
holding me.
and make sure that everybody gets to laugh at us
But
in our
boy,
dynamic.
is she happy when they have that sale every year. She gets stoked.
You know what needs to happen? She just ought to call my
your
wife
wife
up and
go
take
on a
her to
shopping
those
day.
pre-sales.
Yeah, I got it. Awesome.
There you go. All right,
We'll
Fu
just use your
Manchu.
credit.
Whoa.
I like that. I like it. Thanks for your question, Fu Manchu. Okay, SCCA 9526 has a question. He says, my wife and I just got married, and she has a much lower risk tolerance than I do. What's the best way to encourage her and us collectively to invest during a downturn? Because we know the market has kind of been, all over the place recently. What would you guys say to her?
Yeah, so this is interesting. I'm going to give you two answers. I'm going to give you like the academic financial answer, and then I'm going to give you the spouse answer, because sometimes those two don't always align. When it comes to risk and figuring out risk and solving for risk, and one of the ways that you can account for risk is really through education. The more that you understand something, the more comfortable you can become with that risk. We're watching this show on Netflix right now called Wild Croc Territory. I don't know if you've seen it. It's wild. It's so good. This guy is so comfortable around crocodiles. If you've not seen it, you're going to start watching it, and I bet our chat's about to blow up because it's so good. It's wild how comfortable this guy is around crocodiles because he understands it. It's something that's in his wheelhouse. It's something he's familiar with because he's educated on that. So I would encourage you, if you have a spouse who's really nervous about where the markets are right now and nervous about investing and nervous about that, it's a matter of educating that person, educating your spouse about how markets work and what business cycles look like and what happens during a bear market and what a bull market looks like, and try to have conversation where the education level lifts up. Now, here's where I'm going to be a little full disclosure here, Brian. My wife does not always love it when I try to teach her something, right? When I start doing that to her. So we have to focus on are the goals. We focus on what are the things that we want to do and what are the whys. And then we back into how do we accomplish that. So we want to be financially independent. We want to have our kids go to college. And we want to be able to do this and that and fill in the blank. Well, the means and mechanism through which we're able to do that is going to be through saving, deferred gratification, and taking that savings and investing. So those are the two things that I would throw out there.
So in this, because Bo made this thing sound like it was the most romantic discussion that you can have with your spouse, where you're talking about all these things. Here's what I would do if I was in these shoes, is that I think in the short term, there is risk in the fact that you want to have your cash and your cash isn't going to go anywhere in the short term. Your investments seem really scary because they can lose 15, 20, 25%. That's a short-term thing, so you're balancing what do I need, and that's why the financial order of operations does have cash and liquidity in the first step 1 and step 4, to make sure you're in a good place there. But you also have to think about that's short-term money. What about long-term money? Because when you're talking about goals like retirement, it's interesting to me is that when you back out your view from the short term to the long term and you look at it like a 10-year and beyond, all of a sudden that cash starts looking really cruddy Yes, it's safe, but it didn't turn into anything. So it's actually risky because inflation, purchasing power, what it's going to do for you in retirement gets to be a very small. And you're like, oh my man, that's a lost opportunity. Whereas when you look at that, what was perceived in the short term as scary money, when you scope out to the long term view and look at it from 10 years and beyond, you're like, holy cow. So that thing that, yes, could in 1 year or short term lose 10, 15, 20%. When I look at it on a 10-year basis, man, it really does hug that average line of 9 to 11%, pretty close. So if you can think about it in those visions, what's the time frame of these goals? Obviously, retirement for somebody who's just freshly married. I don't know. I'm assuming you're in your 20s or 30s. I'm just making an assumption that that means your money is not going to be. We're talking about gold. It's 20, 30 years in the future. So with that aspect, what feels safe is actually risky long term because the purchasing power is going to be completely decimated over the long term. I grew up in a household where my parents only invested in cash and CDs, so I know what that journey looks like. Meanwhile, if you scope out what is in the short term feels risky is actually the safe thing to do long term to ensure that your purchasing power, your retirement, and your goals are fulfilled. That's how I would have the discussion, is that you've got two different goals here. You've got short-term goals. That's what your cash reserves is going to be doing for you. Steps 1 and 4 of the financial order of operations. Long-term, you want to have investments so that your money can work harder than you can with your back, your brains, and your hands. And that's what your army of dollar bills are doing. And that's what steps 5, 6, 7, and beyond is trying to do for you when we're talking about the financial order of operations.
And it's interesting, Brian, because you said something. We were talking earlier about how, you and your wife were talking, and she was nervous about not having an account in her name. And so you guys said, hey, okay, let's do this account in your name. Even though it wasn't necessarily the most optimal financial decision, it probably would have been more optimal to just use a card that you already had or have it in a joint name. It was the right decision for the relationship. And I think sometimes when it comes to financial matters, that's okay. So when you're talking about, well, how do I get my wife to increase her risk tolerance? The question that may be better to answer is, how do I get my wife and I be on the same page around what we're both willing to accept? Maybe I have to come down a touch and she has to go up a touch, focusing on some of those short and long-term things.
I always think, and I know we need to wrap up this question, but it's a cash triage question too. And the fact that I will ask couples when I'm dealing, because it's not uncommon, we get calls, especially in volatile markets like this, where people will say, I just need comfort. I just need to feel good. So this is a perfect time to ask the question, is there a certain threshold of money in the bank that gives peace of mind? And if y'all talk about it, because you'll go figure out what your cash reserves number is, but maybe your spouse would like to have 20% more than that. Look, there's nothing wrong that you build that into your plan. You get to that 20% higher, but then once you cross that threshold, since y'all had a very good discussion about it, very open conversation, beyond that, then hopefully the spouse feels very comfortable with, now let's focus on the long term and taking that necessary risk to really maximize this money.
Love it.
Yeah, that was great advice. Thanks so much for that question. All right, Ron has a question. He says, wife has $300K in student loans at 7% for a doctorate program, but these will be forgiven in 6 years with her current employer. Should we treat it as high interest debt and pay more than the minimum, or should we treat it as high interest debt and pay more than the minimum and then slow down investing? What do you think?
All right, so Ron, I'll give you the disclaimer first. It's really difficult to give we can't give specific, unique financial advice to you because we don't know all the other circumstances. We don't know what's going on in your and your wife's situation. What we can speak to are some things to think about. Now, Rebe, I'm going to recap this to make sure I've got the facts correct. His wife has $300,000 of student loans at 7% with her current employer. She's on pace for them to be forgiven in 6 years.
Yes.
All right, so the debt will be forgiven. And so the question is, do I pay on it aggressively, or do I pay the minimum in order to have the most amount forgiven, right?
Right.
Did Ron give us any scope of their age?
He did not.
All right, so I'm going to go on a leap here. I'm going to assume medical school took a while to get through, accumulate that much. We're going to say they're probably in their, mid-30s? Somewhere in that ballpark?
Early to mid-30s.
So for someone in their early to mid-30s, Brian, approaching this kind of thing, right? $300,000 in debt, there's this thing that could happen. What are your thoughts? I mean, I've got some thoughts, but what are your thoughts on how you would approach that?
This is where we have even though we have an age difference, we probably share a brain.
Yeah,
because
for sure.
you and I have large sums of money that we owe to institutions together, and we have lots of debates about it. Here's what I think you would say, and I kind of agree with this, is that you've got a unique thing. Look, $300,000 of student loan debt. Holy cow.
It's a lot.
That is, can you imagine trying to eat that elephant? I mean, that just seems overwhelming. Now, you first of all, hopefully, because you've heard our guidance. Now, it's always different for professionals, because you said it's a doctorate program. I don't like people to have more student loan debt than what they can make the first year in the job. So that just 300,000 is such a big number. But here's what I want you to think about this. You gave the information that in 6 years, this could be forgiven by the employer. I really hope they like their employer.
Yeah.
And I really hope they like that job, because that is a tremendous benefit. I mean, if you just take $300,000 and divide it by 6, I mean, you can see that is a substantial sum of compensation that would really make me lean hard on. Take that into account when you're figuring out, do I go take another job? Because that's worth a lot of money. So that's part of your handicap process of figuring out the decision making is, what is that worth and how realistic it is for your spouse to stay at that job for 6 years. The next thing you can do to protect yourself, to turn this into a math exercise, is that whatever you were going to pay on that, within reason, I want you because you're more than likely, you're not going to be able to fund the Roth IRA under a traditional way and other things. But I would like you to probably, over the next 6 years, be able to track what money got put elsewhere.
I love it.
So that you have an opportunity that if you don't get the forgiveness in 6 years, then it's a matter of the opportunity cost was just the interest carry cost that built up in the background while that money went and did some other purpose. And you would only be out that money. And I think if you compared what that cost of interest would be compared to what your money could do for you, if you took advantage of the employer just wiping this debt out for you, that's the healthy alternative I would do.
But you've got to be so disciplined. Here's what you can't do. You can't say, okay, I'm going to do the minimum. I'm going to do the minimum payment because this is going to be forgiven. And then you allow your lifestyle to expand to spend those dollars on something else. I mean, if you can't build it up on the side, then you need to pay that on the debt. But if you're someone who can, just like Brian said, build up those assets on the side, just in case maybe something happens in the employer, they don't forgive those loans, or a policy changes, or law changes,
you might get laid off.
Change jobs. Well, any of these things could happen. I think you have to have your fail-safe parachute in the background. Exactly what you said. But you have to make sure you stay disciplined to not pay the minimum with a plan that is going to be forgiven, and not actually be squirreling away for the winter.
So I think there's probably going to end up being an after-tax account that gets heavily funded.
Yep.
Just in case this debt's not forgiven. And that way your opportunity cost is the interest carry cost, which is going to be substantial. But man, it could be a big windfall if all that debt is forgiven in the future. So I would come up with the best of both plans. Now look, both said it. We don't like to give individualized advice because we don't know all your scenarios. We don't know your age necessarily. So this is just anecdotal information. That's something definitely, if you're at the state where you have good income, you have decisions that are this big, 6-figure decisions, man, that's something where hopefully you'll get to the point where you're taking it to the next level. That's so that you can make sure you really fine tune all the asterisks and details so your plan doesn't have the disclaimer we just gave. We just come up with the best course of action.
Great.
Awesome. All right, let's move on to JJ's question. He says, I am 32 and I am on pace for being debt-free, including my home, by 40. Would you recommend being more aggressive towards my mortgage and paying that off sooner, or should I max out both my wife and my Roth? The age-old question.
All right, JJ, I'm going to give you the disclaimer. We cannot give you, we can't give you personalized advice, but I'm going to tell you what I think, right? I'm just going to be honest with you here, right? If you're 32 years old and you're on pace to be debt-free by 40, that's awesome in terms of showing how disciplined you are. You're willing to make some decisions that other people aren't willing to make. You're willing to do things that other people aren't willing to do. But here's what I want you to do. I want you to go to our website, moneyguy.com/resources. And we have a deliverable out there. It's totally free that shows how powerful your dollars can be. And for a 32-year-old, I want you to go see how powerful every dollar that you can invest for the future can be. And then I want you to go look at a 40-year-old, what that number drops to. The number at 47, I don't know what it is at 32, but it's in the double digits, right? What you're basically trading right now in order to be debt-free is getting rid of some of the most powerful dollars in your army of dollar bills. So I would encourage you to think about the optimization idea. If I was going to optimize my financial life, would I be better served by putting that money to work for me, earning a stated rate of return over the long term, or satisfying debt, and I'm going to say even low interest debt on a mortgage right now? And I think you'll be amazed when you run the math, which one comes out more favorable in the long term.
I always, JJ, it's one of those things. Look, I love that we know a lot of other content creators, and we're friends with Andy Hill, and Andy is a content creator. I've been on his show, and he is very proud to tell you he's completely debt free and his house is paid off. But I got Andy to admit that while him and his wife were in super high income situations, they were not prepaying that mortgage until after they had already been investing north of 25% of their gross income. What I worry about when people tell me they're so excited about being completely debt-free, because your question kind of gave part of the answer that I was looking for on data gathering, and the fact that, or should I be maxing out my wife's Roth or 401k? I think that's the way the question. That's what makes me, if you go back to financial order of operations, step 6 is maximizing your retirement account. You can't move on past step 6 unless you've reached 25%. So now if your income is lower than like $85,000, then maybe that's true. You're not getting to the $20,500 of the 401k, but you've hit 25%. But based upon the way you've asked this question and how much money we're talking about, I feel like you might be above that point. So that makes me feel like you're kind of prioritizing the mortgage more than you are your future self. Because I think that paying off your mortgage when you're sub 45 is just cherry on top of the whipped cream of your financial sundae, where you've really done a great job. And once you've already done all you have to do, you're going for extra credit points and say, well, let's go ahead and knock out the debt. And this is especially harder now with anybody who's gotten a mortgage in the last 5 years. And the fact that you very well could have a mortgage that's like 2.5% to 3%, while your cash is just your straight up cash is making 2.5% to 3%. The opportunity cost is so slim on that it's just like, what are you gaining? I get the peace of mind. And that's why I always say there's 2 components to risk, because we hear people bring up risk all the time. Below 45, your risk is you won't be successful and wealthy, so that your money has the opportunity to work for you when you're 60 and beyond, when you actually want to take a break and take a breather and travel and enjoy the fruit of what you've created. It would be nice if your money would do all that heavy lifting for you. So the risk sub 45, meaning from 20 to 45, is, are you going to get to the critical mass that your money will actually do the work for you? Post 45, I'm hoping you did all that stuff from 20 to 45, that post 45, because Bo has already shared, the money multiplier just is not as powerful for older people. Your risk is now, can I keep my wealth? So let's take out more risk things, and having a mortgage is definitely a risk element. Let's pay that stuff off. I'm just worried for a 32-year-old. Have you done everything you need to ensure that your 60-year-old self really does have that critical mass? Because realize, every dollar that goes to pay off that mortgage in your house, yes, it's a paid off mortgage, but it's not really doing anything for you. It's just sitting in the house. The house is going to appreciate at inflation rate, no matter whether it's got a mortgage on it or whether it's paid off. And that brings it back to, what's the interest cost? And if your interest cost, if this loan's within the last 5 years, is probably about where cash is now. So that you can see how this turns into a risk element of, what am I actually doing here? So just make sure you're not cutting the corner off of wealth building by paying off the mortgage. You get that feel-good feeling when you haven't checked the boxes on your long-term success first.
That's great.
Awesome. All right, let's move on to Cody's question. He says, my brother-in-law's longtime friend just sold him some whole life insurance. He is 26. He's saying, in my opinion, I'm thinking it might be my place to lightly bring up that whole life insurance is not a good deal for him. So what do you think about that? And what should I focus on why this is the case if he does decide to bring this up?
By the way, Bo, brilliant, well played, Cody. You can edit this part. Just make sure you take out the first 10 seconds because you can just give them a link to this. Just make sure you curate the first 10 seconds so they know it's not you asking, but maybe you're using an alias on this thing.
Oh, I saw this video. Wow, you should answer this.
Because we all have somebody. That's why I love it. Of course, there's a brother-in-law in this story. I mean, of course there's a brother-in-law. And Bo, you can give color to this. Is that because I had a college roommate who then was an adult roommate, and he's turned out tremendously successful now. But he went through a period where he was in the financial world, and I knew that he must have been on desperate times. When he was calling to try to sell me stuff. I'm like, dude, I'll see you tonight. Why are you trying to sell me a product?
Yeah.
You know, when we live in the same apartment together, you know, but I could tell he was in a desperate situation where he's cold calling. And just coincidentally, my mother-in-law texted me this morning and goes, hey, I just got a call from a Merrill Lynch guy, UGA grad. He wanted to know if I was interested in getting a second opinion on his portfolio. And her comment was, are they so hard up that they're cold calling, you know, people?
Yeah.
And I was like, yes, that's exactly. So it's not uncommon. The majority of the financial space is salespeople. So you better have a really big understanding of what the why and what it can do for you, because products, especially like whole life, and I'm going to let Bo kind of give you the meat on this because he actually worked in this industry for a brief period of time. But whole life is very profitable for the person that sells it. So, Bo, with that, give Cody your thoughts.
Yeah, Cody, if I were going to be talking with my friend about this, and he's 26 years old, I'd say, hey, first of all, why are you buying life insurance, right? And you need to figure out what the answer is, because the reason that life insurance exists is to protect the lost income of someone, right? So if this 26-year-old is married or has kids or has debt obligations or has someone who's depending on their income, and if they weren't here, that person would be disadvantaged because of that, then they have an insurable need on their life. You can justify it. I know for a lot of 26-year-olds, they're just young and single and not married, and no one is dependent upon them. So first I would say, okay, why did you buy life insurance? Now let's assume that there's a justifiable reason. Oh, I've got a wife and I've got kids, or I've got these things going on. Well, then it's okay, well, how'd you decide on how much I need? And you kind of go through and say, oh, I need $1 million in coverage. Okay, great. You land on whole life. How much does it cost? And it's going to be some number that's way up here.
It's going to be a 5-figure number.
It's going to be a big number.
It's going to be a big number. Maybe, yeah, it's going to definitely be don't you think it's going to be a 4 to 5 figure number easily?
Yeah, for sure.
It's going to be in the thousands of dollars.
Meanwhile, for that same amount of insurance coverage, because that's what we're talking about here, insurance, that person could go out and buy $1 million policy for a couple $100. We're talking about
a few
like
$100.
three-digit numbers now, right? And say, okay, hey, friend, why did you opt to pay this much more for this thing that you could have got for this much? Well, then they'll start talking about, well, yeah, but I can build up cash value and I can invest it and it can grow. Say, hey, guess what, man? You can build up value in an investment account on your own and grow it without having the life insurance structure. This goes, oh, no, but this is tax-free. Hey, you know what? So a Roth IRA is actually tax-free, and then you can put money in like a 401k or not. That's actually tax-deferred. But when you get to the end of this insurance product thing, you build up all this cash value, and you ask the insurance agent, hey, how do I get to this? How do I get this money back out? You got to borrow it. You got to borrow it from yourself, and you have to make sure that you leave enough value inside of the policy for eternity so that it does not lapse, or else all those distributions that you borrowed from yourself would end up causing a taxable event. So you're basically betting on one thing. I will have enough money to either pay for this policy out of pocket or leave cash value in it before I die. So it's basically a race to what runs out of money first. Do I die, or does the insurance policy run out of money? Why would you set yourself up for that game? In my experience, most 26-year-olds, when you run the numbers of just buy super low cost, high coverage term, you take the difference in premium, you build that wealth somewhere else in some type of account. In the majority of circumstances where we run this, you come out advantageous. So if I were talking to your friend, I would do the Socratic method. I would just start asking him or her questions. Hey, why'd you do this? Oh, what about that? Well, hey, why'd you do this? Oh, what about that? not trying to tell them to change their mind, but trying to coach them to see if they arrive at a different conclusion once they've worked through those things.
I think to give it steps and structure, Cody, if you actually just went to moneyguy.com/resources, download the free financial order of operations, and just start pointing at boxes. Be like, hey, I know that insurance policy is costing you this many thousands of dollars a year. Have you funded? What do your emergency reserves look like? Are they in a good place? Man, that's your emergency reserves aren't full, but you're paying that many thousands of dollars a year for this. What happens if you lose your job?
Yep.
I mean, because how about Roth? That's tax free. Have you funded that or the HSA? How about even your employer match? If you find out, because what I find for 30-somethings, 20 and 30-somethings, is that you have that messy middle. I mean, especially once you get married, you start having children. There are so many things reaching into your back pocket or your purse to try to get to your money. You don't have enough to spread it out all over the place. So when you start comparing, hey, I've got thousands of dollars going to this insurance policy that I could probably cover the exact same thing for $400 a year. Man, that money would be better used if I could actually spread it out to all these other pots, like my Roth IRA, my emergency reserves, so that I'm building wealth. Because I always remind people, what insurance companies, what do you think they do with that cash value and other stuff? They go and invest it.
It's a very common sense question.
So now you have to ask yourself, what do I cut down the headwind of the cost? Because the insurance company, I know the commission that they're charging is very large. They have to pay out a sales force. I know that they got really fancy people that are out there doing all the investing, and they can't be cheap. So there's just a lot of headwinds that are getting hands in the cookie jar. And there's nothing wrong with permanent life insurance. I've actually used it. It's just that the lion's share of majority of the population doesn't make it through the financial order of operation or reach the level of success where they should be using permanent insurance. That's the problem, is that there really is a percentage of the population that benefits from permanent insurance, but it's not the majority. It's not the lion's share. It is the exception, and that's where the majority of people selling life insurance are pitching products to people that would probably be better served getting the coverage at the most affordable price possible, and then using the rest of the money, investing the difference or using the money elsewhere for a better cause to their financial life.
Hey, good on you though, Cody, for wanting to take care of your friends. That's awesome. Good for you for caring about the well-being of your folks. I love that.
Thanks for your question, Cody. All right. Zeitler has a question. He says, I am interested in becoming a client in the somewhat distant future, but he's looking ahead to that. He says, how do you guys make your money? A free handout told me to ask this question, which I loved.
Clever. Brian, why don't you talk about a little bit, we'll talk about when you hire a financial advisor, there's really two distinct business models, right? Well, I think let's talk a little about the business model, then we can talk about where we fall and why we fall in there.
Yeah, I mean, there's two business models. There's commission-based, and then there's fee-only.
Yep.
Well, I guess there's three.
There's kind of
fee-based.
It's
the gray. It sits right in between commission and fee-only is the fee-based. That's your wrap accounts and other things like that. So commission, let's start with that. Commission means, and that's where your life insurance agents, your brokers, where every dollar that you invest, they're just basically getting a front-end commission off the front end. It's not uncommon, like life insurance, whether you're talking about term, permanent, a lot of times the first year premium
might be their commission.
The majority of that is going to be their commission. So you can kind of really get a caliber of what that is. On mutual fund sales and stuff like that, if it's just straight up commission, it's going to probably be like a 3 to 5% commission, because one of the bigger commission mutual fund companies, I think their A shares is around 5.75%.
Yep.
And then you've got fee-based and fee-only, where a lot of that is what's called assets under management, where you'll see typically a fee around 1% per year that is charged. And then fee-only can also have subscription as well as hourly models.
Flat fee.
I think before I kind of get into the nuances of fee-only, it's important to share, though, that when we go and talk to universities and others about this, the unicorns of the industry are the fee only.
Sure.
I mean, when last
segment.
time I did the research on this could have changed, because it's probably been 2 years since I did this, because the pandemic kind of shut down us going to those capstone classes and so forth. but it was what, 2.5%? Where
3 was the number I had in my head. so
2.5
right
to
around
3% of the entire financial industry is fee only. The other 97% has some sales component and commission component to it, because the fee based might look like the fee only because they're just doing a wrap account at the around the 1% mark, but then they also can still sell you life insurance and other things that have full commissions. There's different disclosures and structures, but fee only, that's the hourly advisors, that's the subscription model, and as well as the assets under management. We do work assets under management, and I'm pretty unapologetic about it because what I have found is that the financial world changes so dynamically, so quickly, that I could do a one-time plan for you, but I'm not so sure that plan would be great for you 7 months in the future. Because, I mean, think about what's going on in this market downturn right now where currency exchange rates have changed dramatically. When's the last time you heard that the dollar was sitting at equilibrium or even more power, more strength than what the euro is doing? I mean, it is. So that has a huge impact on a part of that. Also, the difference between different asset classes, all that changes constantly, and you have to have your hand on it. Look, it is true. The core of your investment is probably going to be index funds. We tell you that's great on the part of the abundance cycle with learn, apply, grow. I want you to do that to build wealth. We do that for our own assets. We do that for our client assets. We love index funds, but there will come a point in your life where simplicity that you crave is actually running from you because of your success. It's just, you don't even have to look for it. It's just going to happen. I look at my tax return every year and I go, dadgummit, Brian, how did you get so complex with all the K1s, all the different things that are flowing through? And I think a lot of you financial mutants, you have the exact same thing, is that I can load you up in your 20s and 30s with all the things where you don't need to hire anybody, but then you're going to get to close to your 40s or even late 30s and you're going to be like, Brian's right. We got daggum complex without even trying to, just because our financial success has created all of this that's going on, because it's the financial planning that I find, because asset allocation is very important, but that's not where it ends. I mean, we review tax returns every year. I mean, we do retirement plans. I mean, I've got some executives for some of these public companies that are, if you're in the technology space, there is all kind of restructuring going on. We had an all hands on deck meeting last week. We're having an all hands on deck meeting next week because this client needs to know right now, what are my financial options, because things are moving and they're changing very quickly at this company I'm at. And we're working through that. And you can't tell me that client who's been with me now for, I mean, probably 12, 14 years. Right now they're going, man, I am so glad that I have somebody who on an ongoing basis can have as many meetings as they can to figure out, what does the next chapter of my life look like? Can I go to this other company? Can I actually retire right now? That type of stuff, it just happens automatically as part of the way the financial world changes.
Yeah, and an important thing to note is when selecting a financial advisor, all financial advisors have conflicts of interest. Whether you're working with a commission salesperson or whether you're working with someone who's fee only, there are conflicts. And just because someone is in one model doesn't mean that they're not a good financial advisor. Don't mishear us on that, or doesn't even mean that you shouldn't work with them. The reason that we've landed on this side of the camp, and the reason why we're fee only advisors, the reason why we work on assets under management, is we wanted to give the highest probability of being able to remove those conflicts. We can disclose them up front, talk to our clients about where our conflicts exist. Like, hey, if you pay off your mortgage, we're going to make less money, but guess what? We still think you should. Or, hey, if you don't pay off your mortgage, we're going to make more money. And by the way, we think you shouldn't, and here's why. And we put all of that out there on the front end. So what you want to make sure is whoever you work with, you understand where their conflicts are, and you understand that you're comfortable with them, and you understand what they do, because not all financial advisors provide the same services. Some are strictly investment managers. Some take a more holistic view, looking at tax returns and insurance and estate planning and those pieces of your financial puzzle. So make sure you understand what it is you're getting when you work with an advisor.
Wouldn't it be great if somebody put together a group of questions to ask a financial advisor to kind of figure out where they fall with things? So what I would share with you, go to moneyguy.com/resources. We actually have created a resource. Go ask the financial advisors that you're interviewing these questions to kind of get understanding. How do they make money? How do they get paid? where are there conflicts of interest, just like Bo disclosed. And so you kind of know what you're getting into on the front end. It really will create some pretty dynamic conversations and really help you know where you stand.
Great.
Fantastic. Thanks for that question, Zeitler, and thanks for downloading that 8 questions to ask your financial advisor resource at moneyguy.com/resources. All right. Syrup Celine has a question. They're saving up to buy a car 2 to 3 years from now. Where should I park the money?
All right, so if you're going to buy a car, I'm going to answer the question. I'm going to answer if you're going to buy a car in 2 to 3 years, the place that you should park the funds for that is in cash. Purely liquid, safe cash. That's the answer to the question. Brian, I want to talk a little about why is that the answer to the question? Why is that the advice that we give?
Well, I mean, you got to have liquidity. I mean, 2 to 3 years, I wouldn't feel comfortable putting that out there in an investment asset. Like you go do the S&P 500, it might turn out to be outstanding, where you're actually getting 10 to 15% more than you would with cash. But it also could cut the other way, where you could lose 20 to 25% of that purchasing power just because of the volatility of the marketplace. So investment assets don't really hold up. You need a cash equivalent. So we need to maximize that.
And imagine, like, how sick would you be if 2 years ago you thought, hey, I'm going to buy a car in 2 years, and you invest, and then 2022 happens. And right about the time that morning you go out and your car doesn't start, and you look at your account like, holy cow, I don't have the money that I thought was going to be there. So if it's finite, cash is your friend. Now, I do give one little like pivot, like change here. If it's not finite, if like you're thinking, hey, I might need to replace a car at some point in the future, but it might be 5 years or it might be 7 years, I think you can be a little more aggressive in how much you save in cash versus how much you save into a different bucket. But I think you agree with this, Brian. Anytime we have a finite goal inside of 5 years, it should be all cash to fund that specific finite goal.
Yeah, but there is a better way to do cash, though. I think that's the part that you need to focus on. Is that, can you make sure your cash is at least being maximized? Because there is a broad difference from the way financial institutions are paying their customers for cash. Like if you go to your typical brick and mortar bank right now, their savings account might be at 20 to 30 basis points or 0.2 to 0.3%. Meanwhile, if you go look at the online banks, I mean, I don't get any affiliate fees for sharing this. I just personally use like ally.com, which is the old GMAC financing wing. They're paying close to 2.5% now.
Great.
I mean, and they do a pretty good job of keeping up with where interest rates are. And then, by the way, you're talking about a car, so I don't think you're talking about a 6-figure purchase. But it is important for those of you who run really fat cash reserves, because maybe you're in a really high income situation where your emergency reserves might be over $100,000. Do recognize that there are accounts that pay more for $100,000 minimums. Like we see this Fidelity Investments right now, just their cash reserves is like 2.5%. But if you have $100,000, they have another money market that will be like close to 3%.
It's 3.08% as of right now.
So that's pretty incredible. Now look, this might be dated a year from now. It might be higher, might be lower. But at the moment we're recording this, know that. So I would encourage you. No, you have a 2-year goal. So now how do we maximize this cash? Look at your current institutions. If they are underappreciating your relationship and not giving you a good yield on your cash, then go figure out if there's an online or investment option that still keeps it as cash, but also pays you more where the market is right now in this higher interest rate environment.
That's great.
Awesome. Thanks so much for your question. Stephen has a question. You know, Bo, you just mentioned buckets. You use this term. He said, can the guys talk a little bit more about the 3-bucket strategy? I've heard of it. He says he's even heard it is quote unquote mainly window dressing. He just wants a little bit more of an explanation.
So what's interesting is I can see some of the folks in our chat, some of the perennials in our chat that are here like every single time. And we happen to know someone personally, have an insight into their financial lives. I would love to hear them tell you if like the 3 buckets and the allocation of your assets, specifically later in life, is just window dressing. Because the guys I'm talking about, they will weigh in and tell you it is not just window dressing. But first, let me describe what the 3 buckets are and then why it matters. I'm gonna do this very, very quickly. We think that as you build towards financial independence, you ought to have 3 distinct tax buckets. You want to have your tax-deferred bucket. That's like your 401ks and your IRAs. You want to have your tax-free bucket. Those are your Roth assets and your HSA assets. And then you want to have your after-tax bucket. Those are the things that aren't tax incentivized necessarily, but they pay tax as you go through time, but you have access to them at any point in time. And so you have these 3 distinct buckets so that when you get to retirement, when you get to financial independence, no matter what the tax policy in play is, no matter what tax rates are, you can control your tax situation. It's not uncommon, Brian. We have a lot of clients who they might have 7-figure portfolios and they might be living off of 6-figure expense needs, but we're able to keep them in those lowest tax brackets because we'll max out a lower tax bracket from their IRAs and then we'll supplement that from their after-tax accounts, and you can pick and choose which accounts that you do. If all you do is you get to retirement and you have one single bucket and that bucket happens to be a pre-tax bucket, then every dollar that you pull out in retirement becomes fairly expensive because of having to pay ordinary income tax on that distribution.
I thought it was interesting. I actually, industry-wide, there was actually a piece by a person who kind of talks about best practices for financial advisors. And they were making the argument that this is actually a place where most financial advisors are failing to add value to their clients. And it's a large material thing. Because I always say the 2 big things you need to pay attention to, fees you pay and the taxes you pay. And by the way, tax structure means a lot to you. And let me put this in context, because Bo has a great point. When you retire, it especially is very valuable. But even when you're on your wealth building journey, you get in a higher income situation and you start adding asset allocation. Because remember, when you're younger and building that foundation, I'm not against you just buying like an index target retirement fund, because it's just you focus on one thing, really 2 things. How much can you save? And when do you need the money? And it'll do the heavy lifting for you. But you will reach a critical mass where you're like, whoa, I'm in one of the higher tax brackets now. My asset classes mean a lot, because the conservative stuff pays an ordinary income. You think about bonds, you think about your cash and other things. They pay as ordinary income payments. That interest is taxed at your highest marginal rate. Meanwhile, your index funds will pay out dividends, which we know they get the favorable 15% rate. Capital gains, as long as they're long-term, they pay out at a favorable rate. Plus, you have all the cool planning structures with giving to charity, appreciated holdings. There's a lot that goes into it. I would be disgusted with already what I'm in, that tippity top, 37% tax rate, plus all the Medicare surcharges and everything else. If I was picking up all those additional fees, when I can actually just through a good account structure, put those conservative assets over into those tax-deferred retirement accounts. They do what they need to for my asset allocation, but I don't have the tax headwind that I have. You can say that that's window dressing, but that might be window dressing for somebody who's only got $50,000 in investments. But that's why we tell you, somebody who's at the beginning foundational stage, don't get busy doing nothing, focus on this stuff. Do the index target retirement funds or other things where you're focusing on how you get your income up, your expenses down, so your money can get to that critical mass. So that, yes, so you might be right. We might both be right that if you're in the beginning of your journey, this is window dressing for you because your assets haven't reached that critical mass. So focus on, like we share as part of the abundance cycle, go buy that index target retirement fund that is dirt cheap, that all you have to decide is how much can I save for the future? When do I need it? They do the rest of it. You don't even have to put another thought to it. But once you reach a critical mass point, and we always talk about that, that's probably around $500,000 to $1 million. You are going to be like, yeah, this is starting to get to be a big tax impact. Think about Vanguard. We all know Vanguard is beloved for their low-cost structure. But if you go back and look at the media reports in January or February of this year, there were so many people that were taking their big buses, running over Vanguard, throwing it in reverse, backing up over them, and then they, for good measuring, would put it back in drive, running back over Vanguard because they were so ticked off that Vanguard, well, they were. Go look at the press coverage at the beginning of this year because Vanguard had a big distribution out of some of their funds, and people were like, no, Vanguard doesn't do this. They're supposed to have this patented way that you don't pay income taxes, and a lot of people were even calling for the government to step in and do better on protecting investors from these huge distributions, because we even have to do planning on that. Because think about when your mutual funds or you're in some of these funds out there give a distribution that's 35 to 40%.
It's big.
You have $100,000 or $200,000 in this one fund. You're like,
It's a big taxable event.
Pay attention to taxes. Fees and taxes are very important to your long-term success.
Awesome. Thanks for that question, Stephen. Great question. Hopefully that helps shed some light on the 3-bucket strategy. You know, if you ever have questions like this or want a deeper dive, we do talk about this particularly in the Financial Order of Operations course. And also there's always conversation about stuff like this and how people are handling it in our Money Guy Mutant Facebook page, which you get access to if you are one of our course participants. So if you're interested in that, you can go to learn.moneyguy.com anytime and check out those courses. Okay, Harley has a question. He says, the wife and I are 24 and we are on step 4 of the FOO. We are currently at 2 months of emergency savings. We're homeowners and they're thinking about beefing that up. So how do they decide if they are more of the 6 months of living expenses emergency fund people or the 3 months of expenses?
Love it. Love it. Love it. Yeah. So what Harley's alluding to is we say that as you're determining an appropriate emergency fund for someone in the buildings phase, in the wealth accumulation stage, it's often your emergency fund is somewhere between 3 months of living expenses and 6 months of living expenses. Now, when you get later on in life and when you get into financial independence and you get into retirement, even your emergency fund changes. You should probably have somewhere between 18 to 24 months of expenses in readily available capital. But while you're still building, while you are still growing your empire, the answer is 3 to 6. And so his question is, well, how do I know where we fall? What are the things I ought to think about to figure out, am I closer to a 3-month or am I closer to a 6-month?
Everybody's going to be very individualized, but here's the variables that impact this. First of all, how fast could you replace your job? And be honest with yourself. Don't, because I mean, we all like to walk around with our chests all puffed out and be like, man, I am so important. But as we can see in this downturn, you're starting to see the cracks form where unemployment likely will go up, because there's a lot of people that probably thought they were going to be so protected or they're such good employees that they don't have to worry about losing their job, that right now are worried about losing their job. So be honest with yourself and say, how fast could I replace my job? And assume, by the way, when you're trying to handicap where that falls, is it 2 months, 3 months, 4 months? Think about that the rest of the world is burning too, because it's going to be a bad time when this all happens. Because remember, all of these volatility, job losses, market downturns, they're all extroverts. They all love to hang out and they close down the parties. So you want to make sure that you have all those things accounted for. So that's the first thing. Handicap, how long will it take you to get your job with honest eyes? The second variable is how many people in the house work. If you and your spouse work, that actually mitigates a lot of risk, because the chance of both of you losing your job is less than you just one single breadwinner losing their job. So you can actually use that to put the needle closer to 3 months versus 6 months. So those two things are the big variables that you got to make sure you understand. How long will it take to replace my job? How many income sources? And then you can even take into account if you have been investing long enough. Say you're in the latter steps of the financial order of operations, because you're maybe in your 40s and you now have passive income. I say passive because there's no such thing really as passive, except for maybe a portfolio. But maybe you have rent coming in from real estate or other things. You can take that into account in your decision, but you've got to really go worst case scenario. How do I make sure when it really is raining outside that I'm going to be protected?
And there are seasons of life, and I think this is okay, where the necessity of your emergency fund might adjust. You might, when you're an early on young person, early on in your career, 3 months might very well get the job done. But then you start having some kids and life gets crazy and you get pulled in all these different directions. You might need to be 6 months. But then your kids get older and they start getting out of the house and you're building up other portfolio assets elsewhere and you don't have as many draws on your income. Well, then maybe you come back down to 3 months. It is sort of a life cycle of assessing where you are at this present time and this present moment. And just because it's 3 months right now doesn't mean that it's going to be 3 months for your entire financial life, and the same thing with 6 months. So make an accurate estimate of where you are right now today.
Awesome. Harley, I hope that helps you out, gives you some food for thought, and thanks so much for that question. Matt has a question. He says, I'm 28 and I'm investing 40% of my gross, which is very impressive. I am planning on retiring around 50. So how do I go about thinking and knowing what my number should be for my bridge account to last me until I can access my retirement account?
Well, it's pretty easy, Matt. If you can just tell us exactly what cost of living is going to be at age 50 for us, what your expenses will be, and then when the other sources of income are going to come in for you, like pension, Social Security, it's really easy to figure out like a laser-focused number.
Those are all, everything you just said to kind of play along in this game. You also got to tell us, Matt, what inflation will be,
That's exactly
what
right.
rates of returns will be.
It's
going to be. There's a lot of variables. The good news is, Bo, there is a tool.
There is a tool
that we tried to isolate all the variables. So at least, because I don't think anybody knows the answers to all those variables, but you can at least run multiple scenarios. Because remember, I think about retirement is not too different than the entrepreneur that's starting a business, is that you ought to run 3 scenarios. You ought to run what you think will happen. You ought to run, man, that kind of stinks, but okay, at least it's better that I know it's going to stink so I can plan accordingly. And then there's the scenario where you go, hot diggity dog, I'm going to be rich, you know, and you can run all 3 of those. But in the past, we've had trouble because you'd have to go hire a financial advisor. Right. You'd have to just go, man, this is a complex thing because everybody has all these variables. You also have all these outside things with inflation and market performance. That's a variable. So we tried to address that, Bo. How did we address that?
So we actually came up with a course walking you through how to figure out what your number is, your number for retirement. Well, one of the beautiful things you can do is you can adjust the retirement age. And if you're trying to like hone in on specifically, what does my number need to be at age 50 to provide for my life? This will give you a good idea to shoot for. Now, here's what it doesn't do that I think is important for someone who's 28. It's not going to replace having a financial plan at the time when you want to exit the workforce. But what it is going to do is going to give you a horizon line to shoot for, because when you're when you're young, early on in your career, the thing that you really want to focus on is your savings rate. How much will savings impact what life looks like 10, 15, 20, 25 years down the road? And the decisions that you make around how you adjust your financial life should really focus on 2 sort of things, and they're very much connected. How can I either make more money or spend less money with the ultimate goal of being able to save more of that for my future? What the Know Your Number course will do, if you want to go to learn.moneyguy.com, will actually give you an idea of what that number is and back into, okay, well, how much do I need to be saving? What steps do I need to be taking right now today to begin moving in that direction towards that number?
And it does allow, you can say inflation's going to be lower, inflation's going to be higher, rate of return's going to be higher, rate of return's going to be lower. It actually lets you kind of essentially shoot out multiple scenarios so you can plan accordingly. And I think it's important, Matt, I just my own experience share. When I was your age, I thought I was going to retire at 55. That was the goal that I had, and this unique thing happened. I don't regret that I was a hyper saver at a young age, because what it has allowed me to do is that, because there's nothing wrong, Matt, if you think you're retiring at 50, I want you to have all the skills and all the resources so that when you get to 50, you can do that. But you might find, like I did when you get in your late 30s or 40s, that you actually feel so empowered on what you're doing, because we see that with successful people all the time, is you're like, can I leave? Because I'm making great money. I feel like every day I wake up, I'm making the world a little bit better place. And that goal changes, but that's okay, because you've actually done the heavy lifting. It's so much easier to take your foot off of the accelerator later than it is to try to play catch up. So I love, Matt, that you're doing the 40%. I would give you the word of caution. I used to do this, Bo, because easy. If you do that personality profile, if I had to guess, you might be an achiever. Somebody who's that disciplined that can save 40% at 28. Is make sure you are taking a 360 view of your life to make sure that 40% is not at the expense of the whole miser lifestyle. I still want you to bedazzle your basic life. Make sure you're going on vacation, you're building memories. I'm not saying you have to ride first class like all the songs tell you to do and so forth, but you can make sure that when you as a 50-year-old look back at your life in your 20s and go, that's all right.
It was all right.
Because I do that. I talk about I did a trip to Europe in my 20s with my wife. and we got ripped off in every city. We dragged our luggage down cobblestone roads. There was a lot of stuff, and some of the hotels I would there's
not stay at
no
now.
way I could stay there now. I could get, but it's added all to those blossoming memories of all the things that caused you stress in your 20s actually turn out to be great stories you can tell in your 40s and 50s. So just address those things, Matt, and I think you'll be in a great place.
Awesome. Thanks for that question, Matt. Tran has a question. He says, "Hi, Money Guy Show. You guys have mentioned it's good to have deep pockets before going into real estate investing. But how deep are we talking?
Oh.
In other words, how do I know when I can get into real estate investing in some capacity, according to the Money Guy's take?"
Yeah, so what he's referring to is we've talked about our journey into real estate and the real estate transactions that we've done in the past, and how one of the things you want to do is you want to make sure that this is a more mature step in the financial order of operations. It's more of that step 7 type place when you start getting into this. Once you've
Step 8.
step 7, step 8, once you've kind of gotten into doing some of the other foundational basic life stuff that you've done. And so we tell people before you get into real estate, you want to make sure you're deep enough. And the question, how deep, Brian, I'll let you speak to that a touch, but I'm going to answer it very simply. Deep enough that if it goes absolutely wrong, it will not break you. That's how deep you ought to make sure you go.
Yeah, I look at when you get into real estate, it is more of an entrepreneurial thing. It's not going to be passive. The people on social media tell you it's passive. That's laughable to me because every real estate transaction I've had, you're doing something. You know, we've shared commercial. We're having to, line up the people to repair stuff, or even having to do stuff ourselves. When I was doing residential rental, like vacation property and stuff, you still have to deal with the management company and all the other things. It's not completely hands off. But the thing I want people to know when I say deep pockets, and Bo kind of alluded to this, is I want you to truly stress test this thing, run that business plan where you say the 3 scenarios I always talk about, where this is what I think will happen. This is, holy cow, was I wrong? This thing hasn't been rented out for a year and a half. I've still got the mortgage and all the debt and all the repairs. Because the worst thing that can happen with rental property, and a lot of people, because if you don't have deep pockets, you might be buying into property that is what I call low rent but easy access to. Meaning you can buy rental property that's dirt cheap, but you're not going to make a fortune on the rental income. But you're looking at it because it's easy to buy. You can go, the purchase price on this house is so low. You're like, what could go wrong? Well, what can go wrong is usually on those low purchase price houses that are in not the most desirable areas, they have a lot of transition because they deal with a lot of transient residents that will, unfortunately, come in, rip the cabinets off their hinges. They'll poke holes in your walls. I've heard me tell the story of changing engines in the living room. We've even had a listener who said he had a person who lived on the 2nd floor who was repairing motorcycles because he would actually
Ride them up the stairs.
Ride them up a 2x4 or a 4x4, whatever the heck it was, and then repair engines for a motorcycle on the 2nd floor of his condominium or whatever. So we've heard it all. And so I want to caution you to make sure you have enough to where you not only can carry the mortgage, the utilities, and the repairs, but also that you might have to rehab this thing every time you have a resident that moves out. And that what I have the memory of is that I worked with a very successful individual who had probably about 45 rental properties. And the 2009 through 11 period about broke them because they had a lot of transition with their residents. Because if you remember how the real estate market got crushed, especially in South Atlanta during that period, everybody who moved in was ripping out. He got a bad batch of bad renters because this was low purchase price, low rent, and these people were tearing his house up. And then, and he still has the bank asking for the money. And banks, all of a sudden, when they got squeezed, because remember, extroverts, market volatility, real estate values going down, and then jobless, people being out of jobs, all happened at the same time. And banks, guess what they do when things get scary? they start. I've even heard Dave Ramsey tell that story. If you haven't gone out to YouTube and listened to Dave talk about when he went broke the first time, you can still sense there's a lot of anger.
Pain in there.
Well, there's pain and anger because he felt like the banks changed the rules on him. The bank got in trouble, sold to another bank, and then they changed the rules because they looked at all their loans and they're like, which one of these do we think is risky? And I think Dave at the time was like 26. And they were like, you know what? What are we doing lending this much money to a 26-year-old? Let's make him show us he's got the resources to do it. And he couldn't do it. And that's the thing you will find. And that's why, our bankers, they come in, but they're nice to us. We're nice to them. But when they get scared, they're mean.
Yep.
That's one of the things you have to be because they're worried about their jobs. They're worried about who's on the books, and they probably have an overlord on them, whether it's the government or a bank that's taking them over, that's putting their thumb on them saying, you have to find some money for us right now. And you might be the person they look at and go, nope, that person, I think we locked down how they're paying back that loan, and your rules might change. Be careful, because I bet you didn't read every line on that closing statement. Because anybody who's been through a real estate closing, you're sitting there with the attorney, and he's like, yeah, sign this page here, and I'm like, ooh, what's that form doing? Oh, that's just, if in case there's a little minor mistake on here, we can make that change. Okay, that sounds weird. And sign this page here, because you'll sign your name 40 times. You didn't read all those things. I would challenge you to tell me that you read every page that you signed off on. So just be careful with real estate. Bo said it best. I kind of gave the long-winded experience share. I want you to model when that thing is horrible. You've lost your job, or your income's down 25%, your portfolio assets are down 25%, and then you have, if you bought 10 homes and 4 of your tenants have moved out and then decided they were going to really rub it to, because everybody thinks they're hurting the man by going and poking holes in the walls and ripping doors off the cabinets. No, they're hurting you.
That's right.
And you're just like everybody else. That's the thing, is this thing has this whole, we always hear about trickle-down economics. Trickle-down economics hurts the other side too, is because when they think that they're hurting the man by not paying their rent or ripping the doors off, they're actually hurting you because you took the risk on the investment. Be careful of those things, because that stuff can happen and it's so scary. I just want you to be on such solid ground. That's why I always say have deep pockets, because the mutual fund, yes, it can lose value, like if you're buying index funds in the markets and stuff, but it's not like one day your mutual fund's going to, change an engine in the middle of the living room. You just don't have to worry about that stuff.
I wrote down a few questions that I would ask before I do it. What if it doesn't rent? What if it goes down in value and I have to sell it? What if major maintenance, a major critical system is necessary? And then what if I lose my job? If you can't model out a scenario where you can still float it with if those things happen, then I think I'd think twice before entering into it.
Man, I wish we could have gotten out in the front, because we probably lost 2/3 of the audience with my big rant there. That's okay, though.
You guys are funny. Thank you so much for the variety of questions, guys. We love just loading you up with free advice and just hanging out with you in the live stream every Tuesday at 10 a.m. So if you want to keep this going and want to keep furthering your financial knowledge, you can go to moneyguy.com/resources, download all of our free resources. They're just there for you to take and use however you see fit. And then also, if you want to go have a deeper dive or join that Money Guy Mutant Facebook group, go to learn.moneyguy.com and check out our courses. We'd love to see you there too.
I'm your host, Brian Preston, Mr. Bo Hansen. For the rest of the Money Guy team,